When you entered the landscape, when you started off the company, when you took over, what was the landscape according to you at that point of time? What were you seeing there? And what was the opportunity that you perceived to step into that role?
I started out in 98, joined Prudential ICICI as it was called then. We knew that, ICICI was a well-known name, but Prudential was not a well-known name in India at that point in time. So we decided to invite the 1983 winning team to come at a launch event that we had in Mumbai. It was a spectacular event because everybody had access to these cricketers who were, demigods at that point in time. But really that whole decade was around category building and building relevance for the product, the industry, and of course for the players that were present.
He was the youngest CEO. He worked with the largest MNC and shaped one of the finest mutual fund of the 90s. This is MF Chronicles with Ajay Srinivasan.
In terms of how you build the culture, how you build the teams, what was the thought process which went in, what were the bets you took? You became the largest AMC in 2 years within launch.
We used to have this saying going around saying, think different, think big. Not just think different, but you have to think big. Because if you think big, there's a good chance that you'll achieve something.
What gave you the confidence to back Prudential ICICI with all that intensity and firepower? What were you seeing in front of you in terms of the market?
Markets were not very good. You take 98 when I joined as my first CEO, we had the Pokhran bomb blast. 2 years later, I went to Hong Kong and then we had the Dotcom crisis and the SARS crisis. If you look at the period 95 to 2005, there were a fair number of upheavals in the industry caused by various events around. So when I looked at the industry at 98, it was really about how do you build customer confidence and consumer confidence in this industry, this product.
Hello and welcome to another edition of MF Chronicles. It's indeed a pleasure to welcome Mr. Ajay Srinivasan to our show today. Ajay needs no introduction. He's been a stalwart in the industry, the youngest ever CEO at the age of 34, built businesses across India and overseas. Today we are talking to him, getting him to give us an insight in terms of the decade prior to 2005, 1995 to 2005, wherein most of the activities which happen in India and mutual funds, he's seen it firsthand through a lens of Prudential ICICI as what it used to be known at that point of time, right? It used to be known as Prudential ICICI, right? Welcome to the show, Ajay.
Thank you, Vikaas. Thank you very much for having me.
Ajay, when I remember how Prudential ICICI burst onto the scene, and I'm going to use the term burst onto the scene because I think there were a lot of unconventional sort of marketing techniques, etc. used. It just takes me to the cricket World Cup theme. I don't know how many of our viewers would remember about 1996 World Cup, which Sri Lanka won.
Yes.
You remember Jayasuriya and Kalu Vitarna, whom Tony Gregg used to say Kalu. You remember that?
Yes,
yeah?
Of course.
Little Kalu. And I think they just revolutionized the whole cricketing, the cricketing chronicles, if you will. They created this whole concept of pinch hitter, and they just
well before this whole power play thing came about.
Well before this, and they were against, you're talking about power play. They were against powerhouses like West Indies, and at that point of time, Pakistan, and even India. Yeah, it just reminds me that in 1993, when SEBI allowed the entry of private sector funds, it was pretty much like going against the behemoth Unit 64, Unit Trust of India. Yeah, and there was a slew of companies which came in at that point of time, including Birla, including Morgan Stanley, Alliance, and of course Prudential ICICI. What was when you entered the landscape, when you started off the company, when you took over? What was the landscape according to you at that point of time? What were you seeing there, and what was the opportunity that you perceived when you stepped into that role?
So I joined Prudential ICICI as it was called then in 1998.
And if I remember correctly, you were the youngest ever CEO, right?
I don't know, but I was a young CEO. These days, young CEOs are many in the market. But I was a young CEO. I started out in 1998, joined Prudential ICICI as it was called then. If you look at the industry at that point in time, I think it had a number of ups and downs. You had Mastergain in 92.
Yes.
Mastergain raised 4,500 crores. Invested in the market, was a closed-ended fund. NAV opened below par. People couldn't exit. It was a closed-ended fund. I think that caused a little bit of ripple because 4,500 crores in 1992 money was significant.
Yeah.
And then you had Morgan Stanley coming in as a large foreign player. They came in 94. They launched an a closed-ended fund. It was, you get access to the global investment management expertise of Morgan Stanley. They raised over 1,000 crores, I remember. Their funds used to trade at a premium in the grey market.
5 rupee premium.
5 rupee premium. Those days, people used to be following what the premium in this was. And we used to say, this is a closed-ended fund. It's not a stock. but that was the clamor for the mutual fund units of
Sorry,
Morgan
but
Stanley.
50 rupees premium on the form.
On the
On the form.
to get the
application
form itself.
50 rupees premium on the form. Yeah, feel good, yeah.
So we've seen all of that, right? And then, of course, Morgan Stanley again had the same issue. It went below par because markets went down. So we had a number of years where there were these false starts with several funds. Markets were not very good. I mean, you take 98 when I joined as my first CEO, we had the Pokhran bomb blasts. And, two years later, I went to Hong Kong, and then we had the Dotcom crisis and the SARS crisis.
Correct.
So if you look at the period 95 to 2005, there were a fair number of upheavals in the industry caused by various events around. So when I looked at the industry in 98, it was really about how do you build customer confidence and consumer confidence in this industry, this product? Because it was really, that's what we were working for. And I think everybody in the industry was believing that if you create a category relevance, the companies will benefit automatically because the rising tide would lift, a number of boats as long as you did reasonably well, as long as you had a good brand. So the launch of Pru ICICI was one such thing, because we knew that, ICICI was a well-known name, but Prudential was not a well-known name in India at that point in time. However, Indians who are crazy about cricket continued to be very passionate about the game. And everybody remembered the 1983 win of India. Until 2011, that was the only win we had. So it was fresh in everybody's mind that, India had won this Prudential Cup. So we thought, what best to kind of build relevance for the company, the product, than to relate it to the 1983 Cup that India had won and people had very fond memories of. And so we decided to invite the 1983 winning team to come at a launch event that we had in Mumbai. So the entire team, barring 2 cricketers, actually lined it up for that event. It was a spectacular event because everybody had access to these cricketers who were demigods at that point in time. And it really then launched the company in a very different way to a normal launch, because these were things that people related to much more than a typical financial type product. So equally, a number of other things that we had to do at that period of time were around building the foundation for the industry, Vikaas. So if you look at people, I mean, 95, 96, until 93, all you had was UTI in the industry, right? So you were not going to get somebody with deep experience from the industry unless you went to UTI and picked somebody. So even to build a people strategy, to build a talent strategy, I think you had to think slightly differently. And I personally felt it was a good place to go to an FMCG company, for instance, to build a marketing team, because I felt that would again provide a very different way of talking to a consumer than typically what financial services companies talk to consumers, because these were people who understood the voice of the customer, understood how you sell a consumer product to a company. And we felt if they could convert a mutual fund conversation to that, it could be very different to the staid, very normal approach that a financial services company took. So we had to take very different approaches in a number of things that we did to be able to establish that this is a category that you should relate to, can relate to, and can really make a difference to your life going forward. But really that whole decade was around category building and building relevance for the product, the industry, and of course for the players that were part of it.
Oh, interesting that you mentioned that. I'm just trying to think of Prudential ICICI as a startup company at that point of time, okay? Just using today's parlance. And you're building up capabilities, you're hiring people. I remember one of the people who got interviewed by you, or I think by somebody in your team, was asked a very unusual question. How long can you be in the dance floor? So this man was really flummoxed. He says, do I need to dance? So, but the idea was, what is your energy level? Okay. And I think that was something which was personified by your entire team. But coming back to this, if you were a startup, equivalent of a startup, what was the time you're looking at that point of time? You see, because things were in a fair state of flux. You mentioned about institutions evolving. You're talking about a variety of issues that were plaguing. What gave you the confidence to back Prudential ICICI with all that intensity and firepower? What were you seeing in front of you in terms of the market?
I was seeing a very long road ahead for the Indian savings transformation, in a sense, because if you look at where savings were that time, largely physical savings, the financial savings were in deposits, something in mutual funds. Insurance, not even mutual funds. Some amount of mutual funds would have been UTI, which were more guaranteed products that people were familiar with. So people really hadn't had exposure to risk products, not to even corporate bonds, which were higher yielding than deposits, but had some kind of liquidity and some kind of fluctuation in mark to market as interest rates varied. So it is a very different way to be able to then find a way to be able to sell that that opportunity to the Indian investor. And I felt that this was a long game because you always believed that India was going to grow fast. Savings were high. If you look at Indian savings, they were always high. Those days much higher than they are now if you take as a percentage of GDP. And transformation of that savings, we believed even small amounts of movement in that savings into the mutual fund industry could be a very large amount of money coming in. I mean, think about it. At that time, the mutual fund AUM would have been about 0.5% of deposits. Today, it's 30% of deposits. By the way, it was 0.5% of deposits. And that shows you the growth of the industry, right? From 1.5, 2 lakh crores to today 70 lakh crores is a large chunk of it is just money from deposits moving into things that are giving them much better returns. And it was not a movie that we'd only seen play here. We'd seen this movie already play out in the US, where mutual funds were very widely used by individuals. The UK already had a track record of that. So we knew it was not unusual, and we thought that mutual funds would become a mainstay of every individual portfolio. So I think it was a long bet. It wasn't a bet that we thought would happen in a hurry. We did believe that this was something that would ultimately lead to the transformation of the savings habits of the Indians. And I think much of that you're seeing today in the way Indians are saving today.
In terms of the policy framework, which was there at that point of time, there were obviously some tax incentives which were at play.
Yes.
But did you foresee an evolution of the policy framework basis what you were seeing globally? Ki idhar bhi kuch changes honge, and there would be more and more incentives for people to come in and invest, or more and more ease of investing which would come in. What was the policy framework evolution looking like, or looked like in the years that you looked at the industry?
So the big tax policy boosts elsewhere used to be for retirement, whether it was a 401k or the PEPs in the UK, both of which were driven to drive long-term retirement savings through the mutual fund vehicle. In India, actually, the government was very keen at that point in time to both broaden, deepen the bond market, as well as to get more money into equities. You think about it, 1995, if I remember, there was 80% of money would have been fixed income. It would have been about 10-15% in pure equity funds at that point in time. So clearly there wasn't a large market for equity. Even ownership of equity with individuals was very low. So I think the whole policy framework was how could you create a fiscal incentive through tax breaks to be able to incentivize individuals to invest in both bonds and in equity. On the equity side, we had the whole ELSS framework, which was 3-year lock-in money. So incentive to put money in, lock it in for 3 years, but you get a tax break if you invest. That brought some money into equity. I think there was a whole host of benefits in terms of indexation, so that if you held long enough, which led to the whole mania in February and March, because you realized you'd get multiple indexations if you held that. So this whole idea of indexation, which I think came in at that point in time. Debt funds got a lot of benefit. I think debt funds got the benefit on dividends. They had initially there was dividends were tax free. Then they had a smaller dividend payout tax, but this incentivized even corporates and institutions to start putting money in, because they realized even post-tax there was a better return than what they would get putting it in alternate sources of investment for themselves. So the whole tax environment was really to try and get money into both equity and fixed income, and I think that really provided some impetus in the initial stages to the industry.
Interestingly, two other things were happening at the same time, if I remember correctly. One was actually one more interesting thing, that the whole FD market had started collapsing. I still remember my office was on the 10th floor of Reja Center. Okay. And niche was the office of Lloyd Steel.
Sure.
Okay. तो जब भी सुबह आता था मैं, तो Lloyd Steel के बाहर इतनी लंबी लाइन लगती थी लोगों की to go and put in money in FDs.
Yes.
And I always used to think, maybe I manifested it in a different way. हमारे यहाँ कब लाइन लगेगी?
Yeah.
And then of course this whole FD market collapsed, and next thing you know, the 10th floor पे line आनी शुरू हो गई.
बिल्कुल.
And I think safety, comfort, more than conviction.
Yeah, but that would have been later, no? Because not
98, 99. CRB collapse happened around 97, 98 के आसपास.
But still getting money from FDs was still
A big thing. And I think the whole IFA community actually was very vibrant community. Much before anybody else caught on to it. It was the IFA community which caught on to it, and they were the ones who were primarily responsible for this entire show.
Absolutely.
Yeah. At that point of time, I think, if I remember correctly, you were with ITC Threadneedle, okay, and you were just finding your feet into the asset management business. You had become the CIO. You were the deputy chief executive.
That's right.
And that was a period actually which also had the Asian crisis, right? Asian currency crisis which happened. In that period of time, you managed some funds and actually you got an award. Tell us something about that. I mean, what was the fund about? And how did you look at the crisis? How did it influence your judgment, if at all? What was the scene like at that point of time? Because this is something most people don't know about because it didn't happen in India. You were relatively insulated, but the impact in terms of FII flows going in and going out was dramatic. Do give us some insight into it.
So this was 1996, Vikaas.
Okay.
Like you said, I joined as Deputy Chief Executive and was CIO for the ITC Threadneedle Mutual Fund. We had a Englishman as the CEO. So he came with a lot of understanding of what was happening internationally on the investment side. He was an investment professional. And I think launching at that point in time, our first two products we felt had to be vanilla products, but had to be products that would be strong, stable, and have longevity. So the equity fund we launched was called the Top 200 Fund.
Oh yeah, of course.
Yes.
Of course.
Yes.
That became Zurich's top 200
It became Zurich,
fund, and
then
then
HDFC. I think HDFC still runs it.
HDFC,
Still runs it as a top 200.
Completely.
So the idea was you take the top 200 companies of India and you choose a portfolio from the top 200. Benefit being that these are 200 companies that are reasonably large, so risk is slightly lower. They're slightly better researched than many other companies. And there wasn't another fund like that was purely focused on larger cap companies. In that sense. So it made it slightly, at least you drew the outline as to where you were going to look. You're not going to look at the entire market to be able to find stocks. So that I think gave us a good base to work off. We only had to really focus on 200 companies. And I think that was a good way to build the industry as well. As I say, all these were stages where you had to build confidence in the industry. The products had to have the ability to deliver consistently and over a period of time. And we felt coming with a product like that, there was a reasonable longevity and a good chance of delivering decent returns. So that was our top 200 equity fund. We also launched a fixed income fund at that point in time, one of the early ones, because again the view was that you're getting a good pickup over deposits if you do corporate bonds, but again do high quality, good quality bonds that have a decent coupon. And again that fund did well, and that again became.
So this was a pure credit fund.
Pure income fund, yes.
Because I remember we had an income fund in Birla,
yes,
which had, as per the offer document, the leeway to go up to 20% in equity. In a sense, it was probably the first MIP. If you look back.
That's right.
But it was later converted to a pure. Yours was a pure income fund.
It was a pure income fund.
Oh, nice.
So we had one, pure equity fund and one pure income fund. Both of them did reasonably well. Then, of course, ITC Threadneedle got sold to Zurich.
So during the Asian crisis, was there any pressure on you, or because it was the top 200 stocks you were able to?
Yeah, so I think it was because it was the top 200 stocks, I think slightly protected from the volatility in the market, but the markets were very volatile as you know at that point in time. But the top 200 stocks again were well-known stocks, were large stocks. So I think in a market that was reasonably tumultuous, they were slightly better off than the others.
I'm just going to probably pick your brains a little bit more here, because today, when people talk about an FII quote-unquote exodus, they say they're pretty Atmanirbhar and they're taking up the entire thing. At that point of time, it was devastating. I think the assets were not even very liquid. So a little bit of shift here and there, and the markets used to be swinging way
for a long time, Vikaas. I think it's taken a long time where the FIIs really used to dominate. I think two factors. The FIIs used to make obviously an impact on the market with money coming in and out, on the currency, because FII flows used to have a big impact on the currency with the amount that used to flow in and out. And I think it's only been the creation of this whole large domestic base that we have now of money coming in, that you now see the domestic institutions actually having much more sway than the foreign institutional investors, and that's a wonderful thing to see.
I can probably corroborate that, because these headlines used to be screaming all over.
Yes,
and I think people used to take punts. Ki FII ka paisa jayega, so let's short this, let's get into this, because there was no liquidity. Share certificates were still taking a lot of time to come through. All those sort of
things. I used to joke with my investment guys, because sometimes in the evening they'd spend time watching what's happening in the US. Then they get up, watch what's happening in Japan. Then they'll see what's happening in Hong Kong. And I say, you're investing in the Indian market. You're spending most of your time looking at what's happening in the US and Japan and Hong Kong. But those were days that was driving what was going to be happening in India. India was a resultant of all the action that was happening elsewhere in the world.
This looks like mythology and fiction to most people now, but we've actually gone through.
We've been through it. Yes, yes.
So, I don't know whether you've since you follow cricket, maybe you've seen this. You've seen this photograph of Steve Waugh and Curtly Ambrose in one of the series in Australia West Indies series. This is an iconic picture. I'll see if I can get it for our viewers also, in which the West Indies, the fierce bowlers that they were just giving the Australians a lot of chin music, if you will. And here was this doughty cricketer, Steve Waugh, who came in. And there was a ball which actually, I think it just hit him on his helmet. And Curtly Ambrose actually came right up to him. And Curtly Ambrose was like 6 feet 5 inches tall. And they're just looking at each other like this. And that image got captured. Okay. That image got captured. And yeah.
He's got the image. Wow.
Yeah. And it got splashed all across because it was an Australian diminutive guy standing up to the big guy. And in a way, it actually changed the whole dynamics of cricket. If you see after that, the fact that somebody could stand up to a West Indies fast bowler means that, you had to have a lot of courage and guts, and people started following them. And, the rise of cricket beyond West Indies really started to happen. Why am I using this analogy? Because it's pretty much akin to what the private sector AMCs did. Okay, not standing up to a bully, but standing up to an institution and creating their own niche. Because the market was completely dominated by Unit 64 and the people who were selling that. In that time frame, you were building an AMC. Okay, and you mentioned about a few things while launching the AMC. I'm wanting to understand in terms of how you build the culture, how you build the teams. What was the thought process which went in? What were the bets you took? You became the largest AMC in 2 years within launch. So obviously a few strategic bets paid off, but that would have been as a trade-off with something else. Yeah? So take us through this entire process and give us some insight in terms of how you became the largest AMC in 2 years.
So I think the idea was really to how do you build an institution of scale which also has stability and has the ability to build on an ongoing basis. In a period of time when all of these things, you're competing against a very large player, external situation, as I said, was not entirely. It's not that you had a great tailwind behind you that you could leverage, because there was no tailwind. There was every now and then there would be some crisis that would come and kind of push you back. So I think my thesis really at that time was to build a really strong team. It was my first job as CEO. There was no playbook I was following. I was thrown into the deep end to kind of figure out what to do. I had an Indian shareholder who was very ambitious, building out a large bank in India, and Prudential was the same. They were building out a very large business in Asia. So there was ambition on both sides from the shareholder perspective. And it was really then saying, can I get a bunch of people who are driven very differently from what anybody else would be? Because this was a little bit more of a junoon. It had to be something that was more than just a job. It had to be a calling. And a lot of the discussions really was around people, therefore, who had this belief that they could do something that was different. And the idea was really to think about how you could think very differently and how you could think big. We used to have this saying going around saying, think different, think big. Not just think different, but you have to think big. Because if you think big, there's a good chance that you'll achieve something, because you needed to do something very different. I remember our first year, when I joined, we had an annual plan. I remember roughly about 500 crores we were talking about in terms of AUM. You're laughing because that number seems so insignificant, even a few years after. Yeah. But I was greeted with total disbelief from my team. They're saying, we cannot do this number. What are you thinking? It's not possible to do. These are very large numbers. Nahi hoga. And I keep saying, the opportunity in India is large. We have to just get a few things right, and this is not a large number to get. But obviously, the team then bought into it and then delivered more than that. But that was the kind of mindset you had to deal with. So we wanted a set of people who really had the ability to take on things that nobody had done before and were willing to take it on as a challenge. And I think I was really blessed with some really amazing people in that team who really went out of their way to build this category and to build the entity. And that's what allowed us to do this. And I think we did a number of things that were very different. We looked at building out the whole IFA network. Obviously, banks had just about started then. If you look at the distribution network at that time, ICICI was distributing, Citibank was distributing, I think ABN AMRO, few of the foreign banks and Indian banks were distributing. UTI agents were distributors. And then there was the IFA network. So we believe that you had to build the IFA network if you wanted money from individuals, retail. There was a large pool over there. Also equity money, because we felt it was more likely to come from that pool rather than anything else. So the whole push in terms of building out the IFA network, which had to be done. Now think about building that at that point in time. It required recruitment. It required pitching to people saying, why is this a good business idea for you? Why would you do it? So it was a whole host of distributor training and conversion that was required. A whole host of investor education. A lot of the work that we did was on investor education because you had to educate the investor as much about what mutual fund could do for you. And you have to educate the distributor to say, why do you think it's a good idea for you from a business perspective? And why should you then go and reach out to these people? So a whole host of infrastructure building stuff for which you needed that passion and you needed that energy, the dance analogy that you gave earlier, you needed a lot of that if you're going to make that difference. We also realized that the number of folios, if you look at, were not growing that fast, Vikaas. In fact, through that whole decade, if you look 95 to 2005, the number of folios roughly stayed between this 25 to 30 million number, which was broadly the number UTI had, but didn't change very much in that decade. So while the AUM was growing, either same people were adding to their investment or people were leaving and the new people were coming in, but there was no net addition as such to folios. So if you had to really build assets under management, if you had to build scale, because we realized that scale was also a very important part for category building. If you could build scale, you could say, look, there are other people putting in money, this thing is getting bigger, and therefore it builds its own credibility in its own brand. So getting scale was an important part of the strategy to build credibility for the industry itself. That's when we realized that, a lot of institutional investors would find debt funds interesting. And this was the advent of the whole liquid fund era, because from 80% fixed income in 95 with almost no money market funds, if you look at 2005, 1/3 of the AUM was money market funds. 1/3 was fixed income, 1/3 became equity. So, the whole mix kind of changed. So opening up that whole product basket of liquid funds, opening up the whole idea of institutional participation in the industry was all part of this thing about how do you build scale, how do you build credibility, and how do you get more people to start believing in this concept that we were all working towards. So it was you had to approach it from multiple angles and think about every angle from how it will build the category and how it will build the industry.
It's an interesting thing that you mentioned because I think one of the paradigms IPRU at that point of time put out in the market was that look at AUM as a criteria for investing. So the larger the AUM, the more market share we should have.
Yes.
And that is what I think was something which got propagated, which caught a lot of people off guard. Because by virtue of the fact that you had a pivot more towards institutional sales or building up through the institutional money, a lot of people then started shifting here. Then I think that expanded the whole cake even further, which is what you're saying, 1/3, 1/3, 1/3.
Yes.
Because of the pivot. I'm going to say something which is very interesting. We can delete it later on if you want to, but this was a very street smart thing. And I loved and I hated PruI for this. Aapne IFA ka baat kiya na? So I still remember, we used to train these IFAs in UTI's Institute in Navi Mumbai. Vashi, if you remember, okay? What the PruI team did was very smart. The moment these guys, we used to fund them, we used to say, okay, exam karo, play karo. Bahar aate hi na, these guys used to be there, PruI say, oh, you've qualified. Free code. Yeah, your code is this. Start selling our fund tomorrow. I think we'll delete that. But it was, aapne jo bola na, ek junoon tha.
Yeah.
So it was street smartness at its best, which is what I really loved about the firm.
No, and we launched something called the Pru Chairman's Award.
I was about to come to that.
Because I think, again, when you talk about what you're building and how do you make it aspirational for somebody to join this? So the Pru Chairman Award was, at that time, I think the first of its kind, where we would take the top distributors of ours, and based on different criteria, they would qualify to travel to London to actually meet the Pru top management. And it was a great thing for them because it was partly learning for them to go and see how an international fund works, but also a chance to, travel abroad, which those days wasn't as common as it's become today. So these are all ways to make it more aspirational and to make it something that people wanted to be a part of. And I think there was reasonable amount of momentum because, again, I think we managed to grow the IFA base from whatever it was in 95, I don't know the number, but about 50,000 IFAs at least by 2005, which I think really formed the foundation for the growth in 2005 to 2015.
So one of the triggers I think Chairman Club did was actually to build a huge network of goodwill with the distributors. So, as you're climbing up the stairs and you get more and more market share, it is with people whom you're comfortable with rather than convinced. And I think this whole network which was built was phenomenal. I think it was something which all of us took note of. And of course, that was the way it was. We talked about two joint venture partners. You talked about ICICI's,
Yes.
I'm assuming you're talking about ICICI's Indian partners, hunger for growth, if you will, and Prudential ICICI also wanted to be ambitious. But basically, these are two different institutions cut from two different cloths, right? At the end of the day, culturally they're different, maybe functionally they're different. What were the dynamics of the relationship that you saw, that you understood, that you had to balance, and then you harnessed?
So I think ambition was common to both. I think
Okay.
both ICICI and Prudential were very keen to build something that was significant and an entity that had substance and scale. So I think that message was very clear that this had to be a scale business. I think both partners wanted to had big brands, therefore it was very important to build it the right way. And therefore there was no question of taking shortcuts. We had to do whatever it was to build something that was, that would build leveraging the brands of the two. But I think, when you're building a culture which is a joint venture, you have to take the best from both. And I think that was what we tried to do. We tried to figure out what is the best we could get from both cultures. And I think both were very happy to let the team work as long as the business plan was getting delivered. I think we had a reasonable amount of freedom to be able to build the business. And I think therefore you had to make sure that culture allowed you to be able to build the business in the framework that the two shareholders expected, because that gave you then the freedom to continue to do what you wanted to do. But it had to be a culture that was pro-ICICI culture, because I think otherwise if you try, it becomes very difficult. You had to create a culture of your own.
Interesting.
And that culture, I think, had ambition in it, but it also had innovation. I think innovation was a very important part of the culture, because we realized at that time, if you're going to grow, if you're going to create new ways of growth, you have to think differently, because if you think the way that everybody else is thinking, outcome is not going to be any different. So innovation became a very important part of our DNA.
But I remember a quote which you had mentioned somewhere, that talent without chemistry is just noise, right? And this looks like you're feeding off each other. They were probably giving you a lot more freedom because you were delivering, and you were delivering because you were getting a lot more freedom. And
Yes.
It was a unique culture that you were building.
And in fact, in 2001, Vikaas, I went to Prudential in Hong Kong.
Hong Kong.
I was running the regional business for them, and I used the same basis with each of the individual countries that we ran, because we used to have each country business, creating this setup where there was some amount of competition amongst each business, but there was also a very healthy respect of what can I learn from you that I can implement in my market. So what can you learn from Taiwan or a Korea that you can then implement in India, and what can you learn from India that you can then take to other countries? And I think that really created a good synergy for us, and that one reason why I think that business itself started growing reasonably quickly.
So from India, from 5,000 feet to India from 50,000 feet, if you will, when
Yes.
you're looking at it from there, what was the difference in dynamics that you were seeing, India versus other countries which you were dealing with, and India in isolation?
So a couple of things I'd say. I think maybe three things. One, I think in terms of product, India was still much more fixed income oriented. Even as I say, even 2005, 2/3 of our AUM was fixed income. I think many other markets, equity was much more in demand. So I think we kept seeing this, that equities will come in India. It's taking a bit longer, but the rest of Asia had a slightly richer equity mix compared to India. The second I thought was culture, because I think every country had a very different culture, and I think it was important to retain that culture and be aware of that cultural sensitivity as you go from country to country, but also be aware of what you can leverage using that culture. So you had to be aware of that culture, because if you're not aware of that culture, very difficult to succeed in that market. But I thought the cultures were quite different. India had a much younger team, much more driven. The teams elsewhere tended to be slightly older, because that's the way the industry was structured at that point in time. And third, I think, was in economics. I think India economics, even at those period of time, was slightly less than what you'd get elsewhere. Elsewhere, you'd get funds with slightly higher, entry loads, and therefore, the distributor got paid out much more. Investor made slightly less. India came to 2.5% entry loads quite quickly, even though the regulation allowed you a 6% entry load. So I think from all those perspectives, it looked, India looked very different. But India always looked like it had great growth potential. China came later, but at that point in time, India looked like it was always a very interesting market with a lot of different dynamics.
You mentioned about product. You mentioned about building product categories, and you mentioned product again. So obviously, the product stroke innovation thing has been a big factor in not just your success, but also the growth of the industry. If you have to wear an industry hat rather than the CEO hat of ICICI Prudential Mutual Fund at that point of time, how did you envisage the growth of categories? What do you think were the triggers? beyond tax incentives, of course, but what were the triggers which you thought would be becoming more and more conducive for the growth of a category in the Indian capital markets or the Indian mutual fund industry?
Two things. If I go back to that time, it's always you have to think about what you were thinking at that point in time, even though you're thinking it today. I think two things, because if you think about it, a lot of money was in deposits. So you had to think about how the product could be relative to a deposit product, because that's what the customer was familiar with. That's what the investor was familiar with. So your fixed income products had to be a deposit plus product. And that could partly be in terms of return, but partly in terms of liquidity, because deposits had their own idiosyncrasy in terms of liquidity.
Correct.
So you had to therefore think of products that could allow you to be able to do that, which would give you the deposit plus returns with liquidity, and not have the volatility that you would typically get in a market which any fixed income instrument would have. So that's the way we were thinking about fixed income. So if you look at it, liquid would meet that requirement, because short duration, not that much volatility, very good liquidity. So liquid funds became a very big part of that thinking. MIP became very big because MIP was a deposit plus product.
Right, correct.
It was 80, like you said, 95% fixed income, maybe 10% sweetener of equity. If equity did well, you got a big pop in your return relative to any fixed income product. So these were all products that were trying to move money from deposits to either fixed income or some variation of fixed income plus. On the equity side, again, because there had been so much volatility, you had to try and think about products that would give you the sense that this would be something that could stay, slightly longer. And this was the first, we've had open-ended funds for the first time, really.
Correct.
Until then, most of them were closed-ended funds. So balanced funds came in as a result of that, because balanced funds would have 50-60% equity, 30-35% fixed income. So it would give you some balance between equity and debt. Again, you'll get a reasonable return from equity, but you don't have to worry about the volatility of equity. So, and again, a way to move people from where they were into the equity markets. We thought things that people were familiar with. So a lot of sectoral funds came about at that point in time.
The IT funds and all that.
The IT funds came because there was tech mania all through the late 90s.
Yeah.
Then the whole dot-com boom and bust, which led to a whole host of problems for the industry in the early 2000s. But even an FMCG fund that came about was because people were familiar with these products, saying, the products that you buy day to day, all these companies are now part of this fund. And you can buy this fund because you know the products that you're buying. Again, a way for people to relate to a category that they were familiar with, but through an instrument that they were not typically familiar with. I mean, that was the way to think about how to do that. So everything was to try and get people into equity without trying to make sure that they didn't make sure they have a good experience, and to move money into fixed income so that they got a deposit plus kind of return.
Interesting. Some of the things I remember around that point of time was the debut of Grindlay's fund, which later on became Standard Chartered Fund.
Yes.
Standard Chartered Mutual Fund.
Yes.
And I think they just gave a fillip to the entire debt category. You're talking about innovation. You talked about liquid. You talked about MIP. I think some more innovations like short-term income fund.
Yes.
I think that was a category. Medium-term income fund they had created. And of course, the pre-IPO fund, if I remember correctly.
Yeah.
So, moving on from there, we talked about the dot-com boom and the dot-com bust. I think we can spend hours talking about it. I think we've all got our scars from that. By the way, one of the things my learning was from the dot-com boom and bust. Actually, I learned two things. One was that whenever there is a crisis, you should be in front of the customer. If you're not, and I think most of the industry was not at that point of time. This was the first full-blown crisis we had taken, right?
Yeah.
It compounds things further.
Yes.
And the other thing in hindsight, which I realized is that anything which is new, typically blows up like this. It'll flare up and then it'll blow up. But it'll come again if it's got legs. So dot-com came back as e-commerce much later, and I think all of the flare-ups which you're seeing, whether it's in Bitcoin or what have you, my sense is that over a period of time, it'll all probably come back in a more structured way, and regulation has helped that. But talking about structures, I think there were some structural changes which have started happening after that. I think it was around 2002, 2003 when this whole wave of consolidation started happening, right? It started actually before that. I remember Apple got taken over by Birla in 99-2000.
That's right.
Correct? And then I think Zurich got taken over by HDFC.
HDFC.
Prior to that, Zurich had taken over ITC Threadneedle.
That's right.
You had...
and Zurich bought 20th Century as well.
Zurich bought 20th Century as well.
Yes.
You had Alliance, which was picked up by Birla. That was around 2005, I think.
Yes.
Yeah.
Then IDFC bought...
IDFC, yeah. IDFC bought Standard Chartered.
Standard Chartered.
I don't know whether it was IDFC It was anyway.
Yeah.
The,
But it was that decade was a decade of M&A.
yes.
It ended up in consolidation, but I think the maximum number of acquisitions actually happened in that decade.
Why do you think it happened that way?
I think it happened that way, in my view, because I think many people were trying out, looking at the industry, entering it, and then very early figuring out that this was not something that made sense to them.
Achha.
And therefore, at that point in time, probably taking a call that, it's better to exit than try. Because that's why you had these large number of people entering the business, because a lot of them got their license in 93, 94. But, probably a decade out were already out of the industry. Probably they felt either the economics didn't make sense to them, or they felt it didn't fit strategically. But it was a period of consolidation, because none of these were very large, but they just allowed the existing players to consolidate their position. And it became a 30-player industry by 2005. Because although you had many more people coming in, they started consolidating, and you ended up with the guys who were there wanting to build for the future.
Coincidentally, most of them were foreign funds, which actually sold off. Do you think that it was probably the fact that they thought India was too small a market?
Well, you had 20th Century, you had Apple, so some of these were domestic funds as
sold
well.
off.
Yes.
Then you had Sun FNC.
Sun FNC started and then sold out.
Sold off. You had Dundee, you had Jardine Fleming.
Yes.
All of these names, one after the other, they actually started selling off. So what do you think was the reason that they bought?
Again, my sense is, the fact that equity was taking time to build, because equity was going to drive the economics of the business at that point in time. And because the industry was so fixed income oriented, maybe they took a call at that point in time that this was a very long haul for equities actually to become a significant part of the industry. And it didn't fit with what they were looking to build out. It's just conjecture, but that's possibly one reason that they would have done that. Because in all the other markets, that's why I say when I looked at Asia, all the other markets were much more equity rich than India was. India was a fixed income dominated market. Even in 2005, 65% was fixed income.
And come to think of it, I think Templeton showed a lot of perseverance.
Yes.
By staying on and then taking over Kothari Pioneer.
And they really started this whole idea of systematic investment
Absolutely.
plans. I think the origins of systematic investment plans again go back to 95, 2005 decade, where these things really started the whole idea of dollar cost averaging, which was a concept that was an American concept, but they brought it into India, started telling people start investing regularly, don't put lump sum investments at all. So I think number of things I can look at in that decade that really have grown significantly since then.
I still remember when they came in, they started talking about rupee cost averaging on the basis of dollar cost averaging.
That's
there were
right.
a lot of sniggers in the industry. Who makes money putting in 500 rupees per month and all of that?
Exactly.
But I think...
well, SIPs are today the mainstay of the industry, right? So I think it's the origins really started then. And it's a wonderful way of investing retail money, right? So I think it was a very good idea.
Correct. At that point of time, in fact, during this period of time, there were a lot of policy decisions which were happening. More around the infrastructure, if you will, of the mutual fund industry.
Yes.
Which actually, like you started by saying that this was the decade in which the foundation was built.
Correct.
And I think this was probably the time where most of the things started coming in place, right?
Absolutely.
What do you remember about this time that you can share?
So SEBI was set up in 93.
Yeah.
I think SEBI's first big regulations came in 96. I think they were very good regulations because they really set the base for the growth of the industry at that point in time. And those regulations covered various things. It covered daily NAV, which till that point in time, given that you had either closed-ended funds or open-ended funds that disclosed NAV weekly, fortnightly, sometimes monthly, it was a big change, I think, to have a daily NAV. They brought about a whole host of guidelines on valuation because there was a lot of variation in the way people would value portfolios. And I think SEBI came up with an approach on valuation. I think portfolio disclosure started at that point in time because SEBI wanted people to start disclosing their portfolio so that investors knew where their money was going. So I think a number of very interesting and very important steps got taken place in the 1996 guidelines of SEBI. AMFI came about, early 2000s. I think AMFI was formed. Those were early days, and then I think AMFI has played a very important role again in helping build out the industry, especially the campaign that they've run since the mid 2010s that they've done. NSE came about. A whole host of changes in settlement happened as a result of that. NSDL, CAMS. Think about settlement. I think we used to have T+10 settlements for equity funds. I think I remember in this decade it came down to T+3. Liquid came down to T+1 as well.
T+0.
T+0 towards the end of it.
Yeah.
But T+1 for a bulk of the decade was T+1. So all of these things I think help build the confidence and the interest in the industry because the transparency was not a compliance requirement at that time. It was also a competitive advantage. To be transparent was saying, by being transparent, I'm telling you, I'm happy to tell you where my money is going. I'm telling you as much as possible. It was not because I was asked to be told from a compliance perspective. So I think it was a very interesting space in terms of the way the regulations and the whole market infrastructure was actually getting set up. And I think that framework really helped the industry grow in the next decade.
Yeah, I believe, I remember there was a lot of focus on trustees also at that point of time.
The whole idea of trusteeship came about at that time. The whole idea of sponsor, trustee and asset management company and the roles of the three became very clear in the SEBI guidelines as well.
And a lot of cleaning up in terms of the offer documents.
Yes.
Truth of labeling and all of that stuff.
Yeah. And marketing, I think, very, very clearly holding you responsible for not over-promising and making sure there was a basis for what you said. All very good basis, I think, to build the industry on.
Later on, I think it's culminated into a variety of things like riskometer.
Yes.
Now, why this is a necessary discussion for us to have with stalwarts like you is that people understand the backdrop behind regulation. So if there was a riskometer which came in much later in the day, the genesis was this.
Yes.
There was a crisis. There was risk management guidelines which came in, there were best practices guidelines which came in, and there were infractions which happened, which then later on led to more and more disclosure.
Yeah.
And I love what you just said. Competitive disclosure was an advantage.
Yes.
Absolutely. I mean, if you look at it from parallel, if you do with Infosys.
Exactly.
They just turned it into a competitive advantage.
Exactly. Yeah. So
I remember when Fidelity was here, much later, I think it was in 2005 to 15, and they disclosed portfolios on a 6-monthly basis. It turned out to be quite a furor. Everybody said that we will not sell your fund because everybody else is disclosing it on a monthly basis.
Yes.
In fact, some of them were disclosing on a daily basis.
Correct.
Yeah. So
and the fund managers would have this issue saying, if I tell you what is there in the portfolio,
correct.
Everybody in the market will know positions I'm building. So fund managers were not keen. Distributors were very keen because they could then see where what kind of stocks were going in. So you had a number of forces all pulling in different directions at that point in time. But now it's become just normal, right? You expect to know what a fund invests in.
I think it just takes time for things to settle down.
Yes.
In the short run, everything looks chaotic, but over a period
of time,
the
good things get amplified and get built on and continue. And I think things that don't make sense kind of drop along the way. I think that's the way industries evolve.
Okay. So you actually spent a lot of time in Hong Kong, and then you came back to India. You joined the Aditya Birla Group.
Yes.
You turned it around quite successfully, the entire line of businesses here. But specifically from an asset management point of view, because this is Mutual Fund Chronicles, right?
Yes.
And you were one level away now. You were not the CEO. You were guiding the CEO in terms of the business. What changes did you see in the Indian landscape which you thought that this has changed completely? Now I need to pivot my strategy, or I need to ask my team to look at this. And I've seen this thing happening in other Asian countries. Maybe this is something they can take advantage for. Take us through some of the thoughts which were in your mind when you were looking at the asset management business once you returned from Hong Kong.
So once I returned from Hong Kong, although it's after the decade that you're talking about, because it was the decade 2005-15, so it is a subsequent decade. But I think that was a decade where AUM growth really picked up in India. I mean, if you look at the first decade, AUM growth would have been about 4 times. I think roughly 45,000 to about 170,000, roughly that range. And the next decade, I think it went to 11 lakh crores. So it was a big jump in the second decade. So it was a decade around how do you build equity, because I thought equity was a big theme around most of the, and 2004 was a good year from an equity perspective. So you had the tailwind of equity as well. 2004 was also the year that derivatives came into being. So again, you had the ability to see how could I use derivatives to hedge portfolios better than they were before. So from the investment side, it was much more around leveraging some of the things that had happened and how could you do that better. Continued to be around how do you build adequate distribution, but really much more focus I felt on equity and how do you build out equity at that point in time, because that's what we were seeing in Asia, that large numbers of savings was going into equity more than fixed income.
I'm very tempted to pull you back into 2005, pre-2005, and because you've seen the industry grow from a very different vantage point of view. According to you, and you can choose to answer this as diplomatically as you want to, what are the missteps you think that the industry took at that point of time, which in hindsight, probably we would have done better?
So I think the whole tech fund thing was clearly a was clearly too much of risk at that point in time, because I mean, we probably knew it going into it, but I think the impact was fairly significant. Because think about all the things I said. We wanted people to get into equity but not take too much risk. I mean, here you were putting them into tech funds, which are probably the end of the maximum amount of risk, because it's a sector fund in a sector which is fairly volatile. And most of the tech funds raise a decent amount of money. And when the dot-com bust happened, all these NAVs were, low single digit NAVs, causing a lot of grief to investors, but also distributors who started not having the ability to face these investors because of what was happening. I think that amount of risk maybe was too early to take at that point in time for the industry. I think the industry was kind of saved in a way, because the tax breaks, especially on the debt side, allowed us to continue to build fixed income at that period in time. But I just feel some of those things were slightly ahead of their time in terms of the ability of risk that the investors should have been able to bear at that point. The industry, I don't think, was ready for that level of risk at that time.
No, I would tend to agree with you. I think it's a very interesting point, which is why if you realize after 2000, the whole industry pivoted back to MIPs.
Yes.
With a dash of equity, and there was MIP 5, MIP 15 and MIP 25. Yeah.
Yes.
So I think the whole industry pivoted there.
Yes.
And that became a big success. I think that 2001 created that whole category.
You had to understand where the customer was coming from and what they were expecting. And I think the tech funds were probably not what the customer wanted at that point in time.
Also, I think the risk management guidelines post the tech bust became a little bit more. AMFI actually laid out a risk management framework, 30% per sector, 10% per stock, which I think SEBI hard-coded.
Yes.
And gave it a process, which then gave a lot more clarity.
Yeah, but the sector fund still had that flexibility, because in a sector fund there's no sector cap.
Obviously.
But yeah, I think a number of things, group limits, individual stock limits, sector limits, everything kind of came about in this decade again. Yes.
And what were your learnings at an individual level? You famously once said that you learn more from your failures than from your successes.
Yeah.
So any learnings which you had for something which did not work out for you throughout this journey?
Oh, I think so many failures, Vikaas. I think.
So what is the biggest learning which you had? Not the biggest failure, the biggest learning.
So the biggest learning for me was there were just so many crises we faced. If you look at it, I told you 98 when I started, we had the Pokhran blast, we had the Asian financial crisis. 2000 we had the SARS crisis in Hong Kong. I reached there and the industry was the city was shut for 3 months because of SARS. Then you had the global financial crisis in 2008. Then we had, the global financial crisis followed by demonetization in India, then COVID. So I've seen crisis multiple times. I think my biggest learning has been crisis is the best time to see through the fog. Everybody sees the fog in a crisis because you see the pain, you see the uncertainty, you see fear. I think people are able to see through the fog and say, when this settles, what could things be different? And how do you build for that? End up getting bigger gains. And I remember, for instance, 98, like I was saying, we were putting out branches in Prudential ICICI when other people were thinking about what to do because, everything looked uncertain at that point in time. And that same rule book kind of played. Whenever there looks like there's crisis, where can you see opportunity? Where do you see things kind of settling in? And therefore, how do you position yourself? Because these are times you get disproportionate gains. Otherwise, your gains tend to be, pretty. You can be on a steep curve, but it's still a straight line. These things give you the opportunity for either a step curve or an exponential growth, because it's a dislocation in the industry, and that dislocation allows you to take a leap ahead. So I would say learning from crisis and turning that crisis into something that is big for you is probably the biggest learning in this whole history.
One last question. Since you talked about crisis and learning from crisis, I think there's so much of noise around everywhere that everything looks more of a crisis now than what it used to look earlier.
Yeah.
So if there's a playbook for leaders today in the industry, which you would like to lay out, you said seeing through the fog, point taken, everything taken, but that was in a different context, right?
Yes.
Now, instead of every 5 years a crisis, because of the noise which is there, it looks like every 5 months there's a crisis. What would you advise leaders today, to look at, to see through the fog? What is the checklist you will have, or what are the tenets you will give them to see through the fog today?
Yeah. So I would say while markets like quarterly results and the short term benefit that you get from that, I think business is ultimately built on consistency. And I think therefore whatever you do, you have to think about how it consistently allows you to build what you're going to be doing. And therefore, you have to learn to shut out the noise at many points in time, and know that what you're doing ultimately is going to build a stronger business going forward, and inculcate habits that allow you to build this business on a strong footing over a period of time. Because you are going to see much more volatility, you are going to see crisis, but as long as you know broadly where you're heading, and you know the direction and the basis on which you're going, that you should keep that focus on. I think focus, discipline, resilience, I think these are very important skills to have in a leader of today. I talk about it as the marathoner's mindset. I think the marathoner is really my hero in terms of what a leader of today really needs to think of. How do you traverse? How do you think about those 42 kilometers? How do you think about lasting it? How do you think about the setbacks that you'll face along the way? And how do you turn up every day, whether it's rain or shine, to make sure that you're preparing for the 42 kilometers? I think that's the mindset you need to bring every day to your work, I feel.
Interesting. Simon Sinek has written a book called The Infinite Game.
Yes.
I don't know whether you had a chance to read it.
Yes.
He talks about the Japanese philosophy.
Yes.
That, you plan for infinity.
Yes.
So in a way, what you're saying is you plan for a marathon.
Yes.
Don't get too fussed about what is happening in the short term. Always be bifocal.
Yes.
While you have to look at the short term, you have to keep your eye on the long term.
Absolutely. I think that bifocal is very important. I think you can't take your eye off the short term, because
Absolutely.
at the end of the day, that's reality as well. So it's not that you can wish away the short term requirements, but keeping that eye on the long term is very important. And I think that's where leaders have this duality they have to deal with, right? They have to deal with long term, short term. They have to deal with, expense and income. They have to deal with conflict. They have to deal with duality. You have to be comfortable with that duality. And I think one of the duality is this whole issue of long term and short term that you have to deal with.
Absolutely. I think that really defines the role of a leader today, right? Or
Yes.
for that matter, at any given point of time, there's never going to be clarity in its earnestness. You'll always have
And
to
in
deal
any
with
other
that.
role, you may not have to face that duality, right? If you're a head of a function, typically you may not have to deal with conflicts across functions. You may not have to take a call between cost and gain.
Correct.
Whereas the leader ends up having to make these trade-offs. So how you make your trade-offs becomes a very important part of a leader's quality.
Wonderful.
So Vikaas, I think this decade, 95, 2005, if you ask me to characterize it, I would say it was really characterized by foundation building. I think it was really creating the foundation of an industry, really building the basis for something that could then grow to become the industry that it's become today. And I think in many ways, all the things that happened around that time really were around building this foundation for this industry. The new players, the new products, the new channels, the regulations, everything supported the creation of a foundation for an industry that's now become, I think, the mainstay of savings for Indians.
I think we will now ask the students to ask questions.
Sure. My pleasure.
As we know that the asset management industry has come up across the globe over the decades. And also on the other hand, we know that India has also come up as a cricket superpower. So you being a cricket enthusiast, an avid cricket player, what inference would you like to draw?
It's a good abstract question. I think that immediately what comes to my mind is the power of small India, actually, of rural India. Because if you look at a lot of our cricketers today, they're not coming from the big cities. They're all coming from small cities in India. And I think the reason that is happening is because they can see a future for themselves that is much better if they're successful. They know the odds are not great, but if they're successful, the results are outstanding. And I think the hunger, definitely, I feel there is much more hunger in them than the hunger in the large cities. So, if you look at India's 11 today, you'd find most people aren't from any large cities. I mean, if you go back to the time I used to play cricket, bulk of people used to be from Chennai, from Bombay, from Delhi. That's where you used to see cricketers from. You don't see that anymore in the cricket team. And I think you won't see that either in the investing side as well. India is today where it is because money started coming in from smaller towns. People are making money, are willing to take risk, and are willing to put that into instruments like a mutual fund that has just completely opened up India to a level that has never been before.
If I have to look at your journey and the industry's journey, I think let me just talk about your journey first. I think it reminds me of Sourav Ganguly. Sourav Ganguly actually went quite the unconventional way. He bet a lot on young talent. He bet a lot on energy. He cut through the entire bureaucracy, if you will. He had a great relationship with John Wright. And he not only created a winning attitude in the team, it actually created winners. So when MS Dhoni came in and took it over from him later on, there was already a leader whom he had groomed and brought in place.
Yes.
Likewise, I think from an industry point of view, whether it is regulation, whether it is the conduct of players, like all of us have contributed, and more importantly, from the regulator's point of view, and the response which started coming in from retail, this was truly a defining decade. This was something which I think, if it did not happen, with its pluses and minuses, with its highs and its lows, with all the booms and the busts, it wouldn't have prepared us for what came in later.
Yes.
For example, I think because we saw the tech boom and bust, we were able to handle the 2007-8 crisis a lot better by going to customers, and even better during 2020. So I would agree with you that this has been a defining period. And like in life, there is also a cultural mirror, which is why I keep referring to cricket. Cricket is our religion in a way, right? And we've seen parallels of that happening everywhere. So thank you so much, Ajay. Thank you for your time. It was wonderful talking to you.
Thank you, Vikaas.
And such amazing insights.